Have you ever wondered why, despite earning more than we did 5 years ago, so many of us feel completely broke by the 20th of every month? Here's a shocking reality check. As of September 2025, Indian household debt has reached 45.5% of our gross domestic product. But here's the part that should really make you sit up and take notice. Historically, when Indians borrowed money, we built houses or bought land. Today, as of March 2026, 58.4% of all household borrowing is non-housing retail credit. That means we are no longer taking loans to build wealth, we are taking loans to consume. This shift in how we borrow is quietly reshaping the financial future of millions of Indian families. Credit is not inherently evil. In fact, credit is a powerful lever. In the hands of a builder, it moves the world. But in the hands of an average consumer who does not understand the math, it can completely crush their financial foundation. The core issue we are facing right now in the Indian market is that credit has become too easy to access, and the consequences of that easy credit are often buried in the fine print. We are constantly bombarded with offers for instant personal loans, no-cost EMIs, and buy now, pay later schemes. It feels like free money, but it is actually a mortgage on your future income. Why does this matter right now? Because we are bridging the gap between our stagnant incomes and our rapidly escalating lifestyle aspirations purely with unsecured leverage. Today, we're going to break down the actual math behind your loans using real numbers from the Indian banking system to help you understand what you're really signing up for. Let us start by drawing the real dividing line between good debt and bad debt. Good debt buys you something that keeps generating value long after you've paid your last EMI, a house that appreciates in value, an educational qualification that significantly boosts your earning power, or a business asset that generates cash flow. These are investments. Bad debt, on the other hand, funds something that depreciates in value or gets completely consumed while your repayment obligation survives. If you are taking a loan for a luxury vacation, a premium smartphone, or dining out, you are paying for past consumption with future hours of your working life. Now here's where it gets interesting. The interest rate ladder explains almost everything about how lenders view your borrowing. Have you ever noticed the massive gap in loan pricing? Borrowing costs in India currently range from about 7.1% for secured home loans and 8.33 to 14% for education loans. But the moment you look at unsecured debt, the numbers skyrocket. Personal loans will cost you anywhere from 10 to 24%, and if you carry a revolving balance on your credit card, you're looking at interest rates between 36 to 52.86%. The fundamental rule here is simple. The cheapest credit is backed by collateral, meaning the bank has something to take if you do not pay. The most expensive credit is unsecured, priced entirely for the lender's risk of you defaulting. Speaking of credit cards, let us talk about the minimum due button. It's the costliest option on a credit card and, frankly, one of the biggest financial traps in the modern banking system. Most people look at their credit card statement, see a minimum due of a few thousand rupees and think they're managing their debt well. But let's break this down with real numbers. Card finance charges run up to 52.86% at Axis Bank, 47.88% at IDFC First Bank, and around 45% at SBI and HDFC. If you have an outstanding balance of 1 lakh rupees and you choose to pay only the minimum due every month at an annual percentage rate of roughly 42%, it can take you 8 to 10 years to clear that debt. Worse, you'll end up paying 1.2 to 1.5 lakh rupees just in interest. That's more than your original spend. But most people stop here, and that's the mistake. Because once you're trapped in high-interest debt, you might reach the point of no return, which is borrowing to repay borrowing. A typical borrower seeking formal debt resolution right now owes around 5 lakh rupees spread across 3 or 4 different lenders. For these individuals, debt repayments are consuming 40 to 60% of their monthly income. They take a personal loan to clear a credit card and then use a buy now, pay later app to manage daily groceries. The Reserve Bank of India has explicitly flagged this in their Financial Stability Report, warning that impairment and default risks are severely elevated among borrowers holding active loans from 5 or more lenders simultaneously. So, does that mean secured loans are always safe? Not exactly. Think of a home loan. A home loan stops being good debt the moment it crosses your affordability line. Yes, home loans carry the lowest retail interest rates and they offer great tax benefits. With the repo rate currently held steady at 5.25%, EMIs have remained relatively stable. But here's what the data actually shows. The average EMI to income ratio for Indian families has surged from about 46% in 2020 to a staggering 61% today. The golden rule of personal finance is that anything above 50% of your income going towards debt repayment is simply beyond the affordability threshold. Even a low-interest loan becomes a heavy anchor if it leaves you with no cash flow for emergencies or retirement investments. Let us apply this same logic to education loans. India's education loan book recently hit a decade high of 8.58 lakh crore rupees in financial year 2026, growing by about 15%. Interest rates are hovering between 8.33% and 14%. Some private lenders are even offering collateral-free loans up to 1 crore rupees for students getting into premier institutions. But an education loan is an investment only when the return on that education justifies the principal borrowed. Remember, this loan is going to be repaid from your future salary. The earning power of the specific degree in the specific industry you're targeting is the only thing that decides whether this is good debt or a financial trap. And this is the part most investors completely overlook. Vehicle and consumer durable EMIs charge interest on a shrinking asset. Car loan rates currently start near 7.45% and often cross 10%. If you take a 5 lakh rupee car loan for 5 years, you're paying about 10,000 to 10,500 rupees every single month, but your vehicle is depreciating in value from the moment you drive it out of the showroom. By the time you finish paying the loan, you've paid substantial interest on an asset that's worth half its original price. The exact same logic applies to mobile phone, television, and furniture EMIs. And don't be fooled by the no-cost EMI label. The financing cost is almost always cleverly built into the upfront price of the product or hidden as hefty processing fees. Then we have buy now, pay later. This is the debt that doesn't actually feel like debt. Buy now, pay later is designed to split your payments into tiny installments, which deliberately dulls the psychological pain of parting with your money. Research conducted through 2026 directly links the rise of this financing to widespread impulse buying and severe over-indebtedness among young earning Indians. People run multiple accounts in parallel across different shopping and food delivery apps. What you might not realize is that every single one of these small loans is being reported to the credit bureaus. The total exposure often surfaces only when you apply for a critical home or car loan and get hit with a sudden, unexpected loan rejection because your credit profile shows too many unsecured loan lines. But there's some massive relief on the horizon. From January 1st, 2026, the banking regulator stepped in with a rule change that makes debt cheaper to escape. Effective this year, banks and non-banking financial companies can no longer charge prepayment or foreclosure penalties on floating-rate home, personal, car and education loans sanctioned or renewed after this date. This is a game changer. There is no longer an artificial lock-in period. Partial prepayments are fully covered without penalties. This completely removes the artificial exit cost that once discouraged borrowers from early repayment and refinancing. You now have the absolute freedom to ruthlessly transfer your expensive loan balances to lower-rate lenders without paying a heavy penalty. What this means for you practically is that you need to completely rethink your relationship with borrowed money. The insight here is always to match the life of your loan to the life of the asset you're buying. If what you're purchasing won't outlast the final EMI payment, you simply shouldn't finance it. If a credit card statement can't be paid in full at the end of the billing cycle, you shouldn't swipe that card. Historically, what tends to happen is that small, seemingly harmless borrowing decisions mathematically aggregate into total household financial distress. Treat your personal balance sheet with the ruthlessness of a private bank. Every extra EMI you can afford to pay annually now directly attacks your principal balance, shortening your loan by years and saving you lakhs in interest. Everything we've covered today is purely for learning and educational purposes. Your financial decisions should always be based on your own research, your personal circumstances, and, if needed, direct guidance from a qualified registered financial advisor. If you found this breakdown helpful, please subscribe, leave a comment with your biggest takeaway or any questions you have, and share it with someone who really needs to hear it today. This is Ishwar from Paisa Forever, signing off. Stay informed, stay disciplined, and take charge of your financial future.